Welcome back, family. Today, in Part 5, we meet the man dubbed the father of index investing, John Bogle. His simple idea? Low fees and broad diversification beat fancy strategies every time. In 1975, Bogle launched the first index mutual fund. Critics said it was crazy. Why would anyone settle for average returns? But Bogle knew something they didn't. Costs matter. Active fund managers charge 1 to 2% per year. That may sound small, but a 1% fee on a 10% return cuts your gains by 10% every single year. Over decades, those fees compound right out of your pocket. Studies show that over the past 30 years, low-cost index funds have outperformed the majority of actively managed funds, sometimes by 2–3% annually. Let me put it in perspective. Imagine two marathon runners. One carries a 10-pound backpack. That's your active fund fees. The other runs unencumbered. That's your index fund. Over the long haul, who wins? The unencumbered runner, hands down. For my shared house income, each kid's account, and my personal portfolio, I choose ultra-low-cost index funds. Funds costing as little as 0.03–10% per year. At 0.05% versus 1.0%, you keep 95 cents of every dollar earned instead of zero. How powerful is that? Over 20 years, a 0.95% advantage can mean nearly 2 times more wealth. Warren Buffett famously said that most investors would be better off in a cost-efficient S&P 500 index fund rather than trusting their money to complex strategies. Bogle's research didn't just prove index funds work. It ignited a movement. Today, trillions of dollars flow into passive funds worldwide, and families like ours reap the rewards. Here's how to start. Choose a global stock index fund, for example, an all-world ETF. Pair it with a broad bond index fund for stability. Automate monthly contributions, no timing, no stress. By automating into low-cost index funds, you capture the entire market's growth at minimal expense. It's the ultimate set-it-and-forget-it strategy, perfect for busy families. Remember, this isn't about chasing the next hot tip. It's about owning the world's top companies, paying almost zero in fees, and letting time and compounding do the work. Up next, Part 6, we delve into behavioral finance, the surprising ways our brains trick us into bad decisions, and how to outsmart our own biases. Join me as we explore why our minds often lead us astray in investing, and simple steps to stay on track toward your family's financial freedom. Part 6, Behavioral Finance, Outsmarting Your Inner Saboteur. Welcome back, family. In Part 6, let's talk about something sneaky, your own brain. Did you know your biggest money enemy isn't the market? It's your own mind? Daniel Kahneman, Nobel Prize winner, proved we're all wired with biases that sabotage our finances. It's not just being emotional, it's losing money because emotions make us buy high, sell low, and chase fads. When markets dive, we panic and sell. When everyone's excited, we pile in at the top. That's called loss aversion and FOMO, fear of missing out. Kahneman showed these instincts hurt returns year after year. So how do we win? We set rules, automate investments. Don't rely on mood or news. Ignore daily market noise. Focus on the long-term vision. Check in quarterly, not hourly. That's how I protect our family's future. For my boys, I never sell based on headlines. For me, I trust the plan, not my panic. Smart investing isn't about picking stocks. It's controlling you. Want to outsmart your biggest rival? Start with discipline, not drama. Strong habits beat strong feelings, every time. Next stop. The dollar-cost averaging and buy-and-hold strategies that turn emotional traps into automatic wins, so you can relax while your money grows. We'll show you how small, steady steps beat chasing hot tips and get you one step closer to lifelong financial freedom. Part 7. Dollar-cost averaging and buy and hold. Automate your wealth. Welcome back, family. In Part 7, we'll explore 2 straightforward, battle-tested strategies: dollar-cost averaging and buy and hold. These methods harness time and emotion-proof your investments. First up, dollar cost averaging, DCA. Instead of trying to time the market, an exercise even pros fail at, you invest a fixed amount at regular intervals, rain or shine. When prices are high, your fixed dollars buy fewer shares. When prices dip, your dollars buy more shares. Over time, your average cost per share smooths out, reducing the risk of buying a large chunk at a peak. Here's how I use DCA for my boys' accounts and my personal fund. Every month, on the same day, I pull $50 per child and $100 for myself. No emotion, no guesswork. It's automatic. Research shows that lump sum investing slightly outperforms DCA in rising markets, but DCA shines when volatility spikes, protecting you from buying at the highest points. Next, buy and hold. This is the simplest approach. Own your investments for the long haul and ignore the daily noise. Part 7. Dollar cost averaging and buy and hold. Automate your wealth. Welcome back, family. In Part 7, we'll explore two straightforward, battle-tested strategies: dollar cost averaging and buy and hold. These methods harness time and emotion-proof your investments. First up, dollar cost averaging, DCA. Instead of trying to time the market, an exercise even pros fail at, you invest a fixed amount at regular intervals, rain or shine. When prices are high, your fixed dollars buy fewer shares. When prices dip, your dollars buy more shares. Over time, your average cost per share smooths out, reducing the risk of buying a large chunk at a peak. Here's how I use DCA for my boys' accounts and my personal fund. Every month, on the same day, I pull $50 per child and $100 for myself. No emotion, no guesswork. It's automatic. Research shows that lump sum investing slightly outperforms DCA in rising markets, but DCA shines when volatility spikes, protecting you from buying at the highest points. Next, buy and hold. This is the simplest approach. Own your investments for the long haul and ignore the daily noise. Or personal action plan, the ultimate blueprint for lifelong financial freedom. Get ready to design your perfect asset allocation and build your personalized roadmap to wealth with clear steps you can start today. Part 8. The 60/40 Portfolio and Your Action Plan. Here we are. Part 8, the grand finale. Let's pull together everything we've learned and set you up for real, lasting wealth. Meet the legendary 60/40 portfolio. 60% stocks for growth, 40% bonds for stability. Why this mix? History shows it smooths out the bumps, captures market gains, and weathers rough times without jeopardizing your future. For our family, that means the excitement of stock growth and the comfort of safe bonds. So we sleep well at night, even when headlines shout, crash. Ready for your action plan? Here's how to launch your journey. Open accounts for yourself and your kids. Think index funds, broad, low fee, easy to manage. Set your 60/40 target. Automate monthly contributions into both stocks and bonds. Create an emergency fund. Life is not just for saving. Review once or twice a year. Adjust if you reach a big milestone. Otherwise, let it ride. Stick to the plan. Ignore daily drama. Let time and compounding do the heavy lifting.
Today, you've learned the science and real-life proof behind building wealth, even from scratch. I walk this journey daily as a mom, an investor, and your guide, so I know you can too. Whether you're starting small or dreaming big, these steps work. Share your progress, your wins, your questions. Let's inspire each other and grow stronger as a community. The greatest investment is in yourself, your family, and your future. Let's make it real together. Don't forget, like. If this encouraged you, subscribe for the next series and comment below. Which step are you taking first, and what's your money goal? Thanks for watching The Greatest Investment Studies. Here's to your wealth, your wisdom, and the legacy you're building, one smart choice at a time.